What if the absolute golden rule of investing, that undefeated by the S&P 500 and just go to sleep strategy is actually leaving something like $500,000 on the table?
I mean, it sounds almost like financial heresy to even suggest it out loud, doesn't it?
It really does, because for decades, right, the financial world has basically handed you this one standard recipe for wealth.
Hmm.
But suddenly we're looking at a market landscape that is, well, shifting entirely beneath our feet. So welcome to today's deep dive.
We have a really fascinating stack of sources to go through today.
Yeah, we really do. We are tearing into YouTube transcripts from analytical financial creators like Professor G and Marcos Milla. We're pulling from some incredibly intense Reddit debates,
Mm.
and we've got some seriously granular ETF research articles.
There is just a massive amount of rigorous debate out there right now.
And our mission today is to try and settle that debate. We are going to look at whether the legendary strategy of just buying the S&P 500 can genuinely be beaten by a very specific, carefully engineered two-fund combination. But before we unpack the mechanics of all this, I need to state very clearly right up front, everything we're discussing in this deep dive is for entertainment purposes only.
Right. Extremely important to remember.
Absolutely. We are simply analyzing the provided source material and the arguments within it. You should always, always seek professional financial guidance before making any investment decisions with your own money.
Always do your own due diligence.
Exactly. Okay, so with the legal guardrails up, let's set the stage for this heavyweight matchup.
Yeah.
In one corner, you've got the undisputed reigning champion Vanguard's VOO. This is an ETF, or exchange-traded fund, that basically just tracks the 500 largest U.S. companies.
The ultimate set it and forget it fund.
Right. And in the other corner, we have the challengers. We are looking at a tag team of Schwab ETFs, specifically SCHG, which focuses purely on high-growth stocks, paired up with SCHD, which focuses strictly on high-quality dividend payers.
And, if we connect this to the bigger picture, we really need to understand why this specific debate is suddenly everywhere in 2026. Because for a very long time, the absolute gold standard of investing was the classic three-fund portfolio.
Yeah, the old reliable.
Right. You bought your U.S. stocks, your international stocks, and you bought bonds. And bonds were supposed to be the safety net. The logic was always that if the stock market crashed, well, bonds would hold steady or even increase in value to catch you. But then the 2022 market happened.
Ah, right, the great bond betrayal.
Precisely. The stock market dropped about 18%, which is, incredibly painful. But instead of acting as a parachute, bonds dropped right alongside stocks. And we really have to look at why that happened.
Because the mechanics broke down.
Yeah, exactly. When the Federal Reserve aggressively hiked interest rates to fight off soaring inflation, the older bonds sitting in your supposed safety net, the ones paying out lower interest rates, suddenly became completely worthless to new buyers. I mean, why buy an old bond yielding 2% when a brand new one yields 5%?
Right, the price of those bond ETFs just plummeted because the underlying assets lost all their appeal.
Exactly. So investors looked around and realized the old safety net had huge structural holes in it. They started hunting for a completely new way to balance aggressive market growth with actual, reliable downside protection. And that search led the investing community directly to this SCHG and SCHD combination.
Okay, so before we can even look at the data to see if this combo actually beats VOO, we have to kind of deconstruct what these two funds actually are. Let's start with the defense. What makes SCHD different from, literally any other dividend fund out there?
That is the crucial question. SCHD is the Schwab U.S. Dividend Equity ETF. But what's fascinating here is that it doesn't just blindly buy any company that happens to cut a dividend check. It is highly, highly selective.
So it's not just chasing yield.
Not at all. It acts as the anchor of this portfolio because it strictly screens for companies that have a minimum 10-year history of consistently paying dividends, combined with incredibly strong fundamental financials.
It's essentially a quality control filter for corporate health.
It really is. It evaluates metrics like return on equity and cash flow to debt ratios. To put that in plain English, return on equity basically measures how efficiently a company uses the cash its shareholders put in to generate actual profit.
Unlike companies that are actually making real money.
Exactly. SCHD wants companies with bulletproof balance sheets that generate real, tangible cash. And because of this rigorous screening, it has a very high dividend yield, typically hovering around 3.45% to 3.82%. And naturally, it leans heavily into traditional value sectors. We're talking industrials, financials, and consumer staples.
So you're talking about companies like Home Depot, Pepsi, Lockheed Martin, The companies that make the tangible things you buy, regardless of what the broader economy is doing.
Spot on.
Okay, so if SCHD is playing pure defense, SCHG must be taking on all the risk, right? Are we just talking about a tech fund in disguise here?
Essentially, yes. SCHG is the Schwab U.S. Large Cap Growth ETF. If SCHD is engineered for stability and cash flow, well, SCHG is engineered for pure velocity. It is heavily concentrated in the technology sector, nearly 50% according to the research sources we reviewed.
Wow, half the fund.
Yeah, it is designed to capture the high-flying momentum of the market, specifically the tailwinds from artificial intelligence and mega-cap tech. So you are buying heavy concentrations of Apple, Microsoft, NVIDIA, Amazon.
Okay, so here's an analogy that might help visualize what's happening here. Buying VOO, the S&P 500, is a lot like buying a pre-mixed fruit smoothie at the grocery store.
Okay, I like where this is going.
Right. You are getting whatever ratio of fruit to protein the broader market dictates on any given day. And right now, that smoothie is very, very tech-heavy. But buying SCHG and SCHD is like buying your ingredients separately. It allows you to control the exact ratio of high-octane energy, the tech growth to the stabilizing, slow-digesting protein of the dividends. You basically get to be the blender.
That is a brilliant way to frame it. And here's where the strategy reveals its true underlying synergy. The creators we sourced highlight a genuinely surprising statistic about combining these two specific funds.
What's that?
If you look at the actual individual companies held inside SCHG and SCHD, they have essentially zero overlap.
Wait, really? Out of hundreds of companies, the overlap is almost zero.
Almost entirely zero. Depending on the exact trading day you measure, the overlap ranges from 0% to maybe 3% by weight. And that is the underlying cheat code these analysts are talking about.
Because they're looking for completely different things.
Yeah, exactly. Because they're screened using entirely different mathematical criteria, one looking strictly for aggressive earnings growth, and the other looking strictly for fundamental cash flow and 10-year dividend histories. They naturally filter out each other's holdings.
That makes total sense.
Right. By combining them, you are getting the highest absolute highs of the tech market combined with the cash flow stability of dividend value stocks with almost no redundancy. You aren't accidentally buying the same company twice and throwing off your risk profile.
Okay, a zero overlap strategy sounds brilliant in theory. I mean, the logic tracks perfectly. But Wall Street doesn't usually hand out free outperformance without a catch. Let's look at the actual tape. Does this tag team really beat the S&P 500 champion? Let's dive into the hard data over the 3, 5, and 10-year horizons.
Let's start with the big picture, the 10-year horizon. Over a decade, VOO has delivered incredibly strong annualized returns. It generally hovers around 12.5% to 14.15% per year.
Which is fantastic. For a single fund, that is a wealth-building machine.
It really is. But SCHG, the pure growth fund, completely outpaced it. It posted a 17.05% annualized return over that same 10-year stretch.
Let's translate those percentages into narrative impact, though. Because a 4% difference annualized over a decade, that is a staggering amount of money.
It is a totally different trajectory for your retirement, absolutely. Now, meanwhile, SCHD lags slightly behind the S&P 500 in pure total return, coming in around 10.59% to 12.21% over the decade. But remember, it was providing steady, high-yield cash income along the way.
Right, so it's doing a different job. And if we zoom into the more recent turbulence, like the 3- and 5-year horizons, the divergence gets even sharper, right?
Oh, absolutely.
Because over the last 5 years, VOO hit around 12.33% to 14.11%. SCHG maintained its high growth at roughly 13.40%, and SCHG sat around 8.6% to 9.68%. But look at the 3-year mark. VOO pushed up to between 19 and 21%, and SCHG just soared to 23%, totally driven by the AI boom.
Yeah, the AI tailwinds were massive. So what happens when we synthesize the math from all these sources? If an investor took their money and split it exactly 50-50 between SCHD and SCHG starting back in 2016, rebalancing to keep that ratio, they would have seen an average annual return of over 14%.
Which directly beats VOO's 13% over that exact same time frame.
Exactly. In fact, one of our sources, Marcos Milla, ran a very specific projection on this. He noted that a $300 a month investment over 40 years yields about $1.5 million in VOO. But if you do a 50-50 split of SCHG and SCHD, you end up with over $2 million.
Okay, $500,000 is a life-changing difference. But I have to push back hard on this. Are we seriously betting that tech will run unhindered for 40 years? Isn't this outperformance entirely carried by SCHG's unprecedented run in the tech sector?
That is the big question.
Because VOO is market cap weighted. It has a built-in survival mechanism. If tech suddenly crashes or AI turns out to be a bubble and, say, healthcare or energy becomes the most valuable sector, VOO automatically rebalances to make those new winners its biggest holdings. It self-cleanses without you doing a thing. If tech cools down, doesn't this two-fund strategy just completely fall apart?
This raises an incredibly important point, and your critique of that 40-year projection is completely valid. Past performance is never indicative of future returns. The outperformance of the combo was undeniably lifted by the tech sector's historic bull run over the last decade.
Right.
But that vulnerability is exactly why SCHG is the other half of the equation. What you are describing is called a barbell strategy.
A barbell strategy.
Yes. You are avoiding the middle of the road entirely. You've got extreme high-risk growth on one side of the weight bar with SCHG and ultra-conservative defensive dividends on the exact opposite side with SCHD, balancing it out.
Oh, I see.
If the growth stocks in SCHG stumble and fall, SCHD is mathematically designed to be the safety net that catches the portfolio. SCHD's value stocks traditionally perform well during the exact economic conditions like high inflation or slowing economic growth that actively hurt growth stocks.
Okay, the barbell concept makes a lot of sense. You are deliberately polarizing your assets. But since the raw numbers show the two-fund combo can theoretically win, we need to shift the conversation to the practical trade-offs. Why shouldn't you just log into your brokerage app right now, sell off your S&P 500 funds, and buy this combo?
Well, let's look at the specific pros and cons highlighted in the research, starting with a significant pro-income generation. There is a vast difference in the actual cash flow here. VOO yields a fairly paltry 1.13% to 1.3%. It's just not engineered to hand you cash.
Right, it's about growth.
But the SCHD and SCHD combination, even split evenly, averages a 2.11% to 2.5% yield.
Which, again, requires some translation to see the real power.
Exactly. Professor G ran a projection showing the compounding power of dividend growth. After 20 years, a $100,000 investment in SCHD alone could generate over $34,000 in annual dividend cash flow.
Wow.
Yeah. VOO, on the other hand, would only be generating about $4,180 a year. If your goal is to eventually live off the passive cash flow of your portfolio without ever having to sell your underlying shares, the income generated by the combo is incredibly powerful.
And then there's the second pro we need to talk about: downside protection. We talked about the 2022 bloodbath earlier. VOO dropped over 18%. But SCHD, it was only down about 3% to 5% for the year.
It acted as a true safety net when everything else was burning to the ground.
It did exactly what it was engineered to do. But we have to look at the cons. And the sources highlight a major one that trips a lot of people up: tax inefficiency.
Yeah, that is a huge factor.
Let's illuminate the mechanics of this, because I think a lot of newer investors completely miss it. With VOO, the growth is mostly trapped inside the share price. It's what we call unrealized capital gains.
Right, the IRS isn't looking at that.
Exactly. The IRS generally can't touch that growth until you finally decide to sell the shares decades later. But SCHD forces a cash distribution into your account every single quarter. If you are holding this in a standard taxable brokerage account, you are forced to pay taxes on those dividends every single year.
And that remains true even if you automatically reinvest those dividends right back into the fund. This creates what the industry calls tax drag. Every year, a little slice of your compounding snowball goes to the government instead of buying more shares.
Which is a huge bummer.
It really is. VOO is far more tax efficient for long-term holders. Now, if you hold SCHD in a tax-advantaged account like a Roth IRA, that tax drag disappears entirely. But in a normal account, it's a real anchor on your overall returns.
And that leads directly into the second con, the expense ratios. Now, we are talking about microscopic fees here, but they do exist. VOO charges an expense ratio of 0.03%. SCHG is 0.04%, and SCHD is 0.06%.
And while the difference between 0.03% and 0.06% sounds like a rounding error that you shouldn't even worry about, over 3 or 4 decades on a multi-million-dollar portfolio, that extra cost does compound. It acts as a small headwind.
A fraction of a percent over 40 years equates to tens of thousands of dollars.
It really does.
Okay, so having weighed the historical pros and cons, the incredible income and downside protection versus the tax drag and fees, let's bring this into the present moment. How does all of this apply to the specific market conditions going into 2026? Because looking at the research, sources are suddenly claiming that VOO, the golden child of passive investing, might actually be the riskier bet right now. Why are analysts saying that?
What's fascinating here is the sheer level of concentration in the S&P 500 today. Because VOO is market cap weighted, the biggest companies take up the most space. And right now, VOO has become dangerously top heavy. Just 5 to 7 mega cap tech stocks, your Apples, your Nvidias, your Microsofts are completely dominating the index's weight and performance.
So the built-in diversification of buying 500 companies is kind of an illusion at the moment.
It is definitely heavily skewed. You are basically tying the fate of 500 companies to the earnings reports of about 7. If interest rates stay higher for longer, borrowing costs eat into those tech profit margins. If they miss their incredibly high earnings expectations, VOO could see a severe crack in its armor.
And that brings us to the decade rotation theory mentioned in several of the financial analyses we reviewed. Could you break down how that historical cycle works?
Historically, the stock market rotates leadership between growth and value. It rarely lets one category win forever. From roughly 2010 to 2020, and really up through recent years, growth stocks absolutely crushed value stocks.
So that's even close.
Right. But going into 2026, many analysts are pointing to historical patterns and expecting a major rotation back toward value, industrials, and companies producing tangible, immediate cash flow.
Which happens to be the exact sectors SCHD is absolutely loaded with.
Precisely. If that rotation happens, VOO will be dragged down by its heavy tech weighting, while SCHD could surge as capital flows away from speculative tech and back into traditional value sectors.
So bringing it directly back to you, the listener, how should you actually apply this to your own portfolio based on your specific stage in life? Let's break it down by life phases. If you are in your growth phase, say your 20s, 30s, or early 40s, what's the logical play here?
In that growth phase, your ultimate priority is maximum compounding and total return. You have decades of time to weather the inevitable market storms. So heavily weighting VOO or even leaning into SCHG for that aggressive tech growth makes the most mathematical sense.
Well, you don't need the cash right now.
Exactly. You don't necessarily need the high dividend yield or the heavy downside protection of SCHG yet because you aren't touching the money anytime soon.
But then you hit the transition or income phase. You're in your 50s, 60s, or actively entering retirement.
Right. This is where the strategy needs to shift. Here, you might want to start allocating heavily into SCHD. The goal changes from pursuing pure aggressive growth to locking in reliable, growing cash flow.
Because if a severe recession hits during your retirement, you do not want to be forced to sell off your shares of VO at a 20% loss just to pay for your groceries or property taxes.
Exactly. SCHD allows you to live off the dividend cash flow without ever liquidating the underlying principal.
It's all about matching the tool to the specific job. Okay, let's pull all this together and summarize what we've discovered in these sources. VOO, the S&P 500, remains the ultimate, low-cost, incredibly tax-efficient single ticket to the U.S. stock market. For sheer simplicity and self-cleansing diversification, it is unmatched.
It is the default for a reason.
Exactly.
Right.
But if you are willing to actively manage two funds, the SCHG and SCHD combination is a formidable challenger. It allows you to perfectly customize your exact ratio of explosive, high-risk tech growth to defensive, dividend-paying cash flow. And historically, thanks to that zero overlap synergy, it has actually edged out the S&P 500 in total returns.
It is a highly effective strategy when used correctly. And, I want to leave you with a final thought to mull over, one that builds heavily on our discussion about income.
Let's hear it.
We spend so much time in investing focusing on the pure math of total returns, the decimals, the expense ratios, the historical percentages. But consider the psychology of dividends.
The psychology?
Yeah. Imagine the stock market trades totally flat or even goes down for a grueling 10-year stretch. It has happened before. Look at the 2000s. The VOO investor opens their brokerage app, sees a stagnant or shrinking account balance year after year, and the psychological pressure to panic sell becomes immense.
Oh, man. It is agonizing to watch your hard-earned money do absolutely nothing for a decade.
Exactly. But that SCHD investor, every single quarter, they are receiving growing cash deposits directly into their account, completely regardless of the share price. They are physically getting paid to wait.
That completely changes how you feel about a down market.
It really does. Sometimes the best portfolio isn't the one with the mathematically perfect total return. Sometimes the best portfolio is simply the one that prevents you from hitting the panic button when things get dark.
That is a profound way to look at it. The recipe doesn't just need to look good on paper. It needs to keep you from walking out of the kitchen entirely. Thank you so much for joining us on this deep dive. We hope this helped demystify the mechanics behind the numbers and gave you some new analytical tools for your own financial journey. Keep exploring, keep questioning the standard advice, and we'll see you on the next deep dive.